Want to make money trading options, but you don't have the time or a large account? Let me show you a trade that I took this week that made me 26% in one day while minimizing my risk and not needing me to actively look at my screen and have large capital requirements. Hello, this is Credit Spread Investing. I work a full-time job and I'm here to show you all how to trade options and invest safely and smartly so that you can accelerate your account growth. There are a lot of strategies when it comes to options trading, but today I'm going to show you one of my favorite option strategies, which is the 1 DTE credit spread that I use to grow my accounts, particularly my Roth IRA because it's a small account. And at the end of this video, you have a good understanding of how to trade the strategy and more importantly, how to manage the risks. So as always, I use my real life trades as examples to demonstrate these principles. I took a SPX call credit spread trade on 10/12 with an expiry of 10/13 one day later. SPX call credit spread of 43.75 and 43.80. Collected a total credit of $130 and sold two, which means my total credit received was $260, ROI of around 26%. My total requirements will be $1,000 because it will be 43.80 minus 43.75, multiply that by 2. So I only really need $1,000 to make this one trade. I made this in my Roth IRA, which is a smaller account. So the good part about this trade is that on 10/13, it expired out of the money, which means that I made a total profit of $260, right? I made that max profit because it expired out of the money. So in one day, I made that max profit of $260. Now let's just go through the scenarios and talk a little bit about risk. So number one, if SPX is less than 43.75, like we saw earlier, we'll make the max profit, right, of $260. Now number two is the risk. FBX is greater than our upper leg of 43.80, then we'll take the max loss, which would be $740. Now why is that? It's because our total requirement to be in this trade is $1,000. It's 43.80 minus 43.75 times that by 2, which would equal this $1,000 right here. Now, because we've already collected a total credit of $260, right? Originally, the credit received, our total max loss would be that $1,000 minus that $260 that we already collected, which will be the $740 that you see above. Right, so basically what you're doing here, without any trading whatsoever, without any stop losses, without managing the trade, you're risking $740 to make $260. That sounds bad off the top of its head, but the beauty of that is we entered the trade, as you'll see later, around 43.50, which means that the market has to go up 25 points in one day in order for us to be at risk of taking any losses. So this is why on this channel, we like to sell options because it lets us win more consistently. So let's get to it. The math is really simple. If I can make consistently, for example, $200 and I win 4 times out of 5 times and I only lose $200 every time I lose, I'll still come up on top and I'll make $600 at the end of those 5 trades. And you want to do that consistently. That only comes with being very disciplined in how you enter and very disciplined about how you exit. So we're going to talk about both of that today with this one example. Number one, when we look at entries, we have to understand what the market trend is so that we understand which side of the market to trade on. So tip number one here is when you're trading 1 DTEs or even a little bit longer, such as weeklies, you want to be at a higher time frame. I tend to be at a 30-minute time frame. So number one, market trends. Market structure indicates to us when certain patterns are forming or have broken. So let's just run through this example. This goes from a low to a high, to a higher low, to a higher high, to a higher low, right here, right? But on Thursday, you can see the higher high didn't form. So this trend that we just drew out is no longer valid. It hasn't continued to go up and speed up to like 4,400, but instead reverse lower, making this right here an area of resistance, which means that the uptrend that we saw it has been broken. And then I wait one more confirmation to indicate that the reversal has started. That next indication will come here where my cursor is around 43.50. That is the previous swing high and is also the previous support. So once it broke that support, What that tells me to a certain extent is that the uptrend is no longer valid. It goes from A to a B to a C to a D to an E. Now the F didn't form, but because the F didn't form and it broke the lower low, the higher low, and formed a lower low, you can now assume that the downtrend is now going to start forming, at least on the short term, right? And that we're trading 1 DTEs here. That at the end of the day, when I entered around 43.50, the market would need to swing high somehow and break past this 43.85 for me to lose on this trade. On 43.50, at the end of Thursday, that's when I entered this trade, and I was able to get $130 per spread on this trade. And then so obviously the market went higher, formed a lower high, swung down. We made max profit. Pretty simply, 260. We weren't really ever tested. So the next step that you should always do when you take a look at these trades is, how do we lose? Okay, and so I'm going to be hypercritical of myself here so that you guys can understand that not every trade I enter is perfect and there's always learning experiences here. What I'm essentially trying to trade here is the break of structure and a formation of a lower high. So I entered on the break of structure. So now I'm really just waiting for the market to wait for a lower high. So what that means is I am waiting to see if the market ever hits this 43.85. If it does, then I'm out of the trade. There's two main scenarios I'm kind of afraid of. One where it gaps up during futures for some reason and it just blows past 43.85. The moment it blows past 43.85, I'll take whatever my max loss at market open, then I'll be out. The second worst case scenario is the market just slowly bleeds up throughout the day and hits that 43.85 and then I'm out, or I'll have to make a tough decision to exit the trade. So on Monday as market open, it's kind of like scenario number one where it gapped up. But because it hasn't hit 43.85 yet, I'm not interested in exiting. Next 30 minutes, it fell off and it started falling down after the fact, right? So you can see how your stop losses are very important to managing your trades. Let's take a look at why that isn't necessarily the best trade that I took on Thursday. And we're going to go to on demand here. There's something that Thinkorswim has. It basically has historical data. You see on the bottom of my screen, 43.75, 43.80, October 13th, $1.30. That's a trade I'm in. So if I were to be at 43.85, a P&L, if it were to hit 43.85, would be around $180 per spread, which means that my risk to loss ratio is around 1.5. Remember earlier when I said that when I'm trading credit spreads, I want to manage my risk properly. So if I trade 5 times, I want to win 4 out of 5 times. But when I do lose that one time, I don't want it to be gigantic. So I usually tend to lean towards a risk to reward ratio of no greater than 1.5. So if it's greater than 1.5, then it's a pretty bad trade. In this case, 180 is around a 1.5 risk to reward ratio. So it's okay, but I would rather it be closer to 1 than it is to 1.5, right? The lower it is, the better. So now, if you were to go look at the charts, what is a better entry? A better entry will honestly be on this candlestick right here at 7 a.m. in the morning Pacific time. Once that candlestick has formed, I can sell right at 43.75 again. But I set my stop loss as 1 ATR above 43.75, which we can just set it at 43.85, right? Because 1 ATR is around 10 points, so 43.85. And let's check our credit and then our risk to reward ratio. So let's go back to Friday and let's go to 7:15, right? Once that large bearish engulfing candlestick is formed. Okay, so let's go 43.75 and let's do Monday expiry, right? 1 DT. So 43.75 to 43.85 will be around $210, give or take. I got $80 more for basically the same trade time, and let's analyze this trade. Right, if it went to 43.85, I would really be down only $100, right? So my R ratio now is actually 50%. I collected 210, but I would get stopped out at 310, which means that I only lost $100. Risk to reward ratio is now 0.5. So you can see how this trade right here is a much better trade than the trade that I entered. Obviously, the trade panned out, right? But when we trade, we always have to take a look at what we could do better. And this is really the secret sauce here. Make sure you guys look at yourself very critically and see what you could have done better. If you guys have any questions, drop a question down in the comment section below. If you guys want to see my favorite credit spread strategy and how I make $1,220 a month using this strategy every month, make sure you guys check out this video right here.